Before we jump in, here's a quick plug for Insightful Value, where we uncover undervalued companies hiding in plain sight. If you like actionable breakdowns without the fluff, you're in the right place. Now let's talk BASF. The stock is trading at a level that has value investors raising their eyebrows. So what's going on, and is this a short-term dip or something deeper? This review is for informational and educational purposes only. It's not financial advice. BASF, one of the largest chemical producers in the world, has a footprint in everything from agriculture to automotive to construction. With operations in more than 90 countries, they're a key supplier in global value chains. But lately, the market hasn't been kind. The share price has seen notable declines, and many investors are wondering if this is a temporary opportunity or a warning sign. From a valuation standpoint, BASF is trading below its historical average price-to-earnings and price-to-book ratios. The dividend yield is currently over 7%, which is high. But as always, a high yield often reflects risk. Revenues in 2023 came in at $68.9 billion, a drop compared to the previous year, mainly driven by weaker demand in Europe, especially in their chemicals segment. Net income took a hit as well, with earnings per share decreasing significantly compared to 2022. One thing to note, BASF recently restructured parts of its operations, including cost-cutting in European plants, while expanding in Asia, especially in China. The big play here is their massive investment in a new site in Zhanjiang, aimed at reducing dependence on Europe's stagnating demand and high energy prices. The margin pressures are real. Their EBITDA margin has been squeezed by high input costs and weak demand in several sectors they serve, including automotive and construction. Still, BASF remains cash flow positive and continues to prioritize dividends, even in tough times. In fact, they've been paying dividends consistently for over 30 years, though the latest payout was flat year over year. Risks? Well, there are plenty. Energy costs in Europe, geopolitical tensions, exposure to the Chinese economy, and the cyclical nature of the chemicals industry. These can all weigh on earnings and investor confidence. So why even consider BASF right now? For one, the stock price might be reflecting overly pessimistic expectations. If demand recovers, or if their China expansion pays off, the upside could be interesting. Plus, that dividend yield continues to offer some cushion. On the flip side, if Europe remains in a slowdown and China doesn't deliver growth, the pressure could persist. It's really a matter of how much risk you think is already priced in. At Insightful Value, we specialize in cutting through the noise and giving you data-driven perspectives on undervalued companies like BASF. We break down the numbers, explain the strategy, and help you see the bigger picture. For more insights like this one and to explore other overlooked companies, check out insightfulvalue.com. If you found this helpful, don't forget to hit subscribe and stay tuned for more videos. Visit our website at insightfulvalue.com for deeper reports and stock ideas.